Beginner's Guide to Investing in Stocks. Investing in stocks can seem intimidating to newcomers, but with the right knowledge and strategy, it can be a rewarding way to build wealth over time. The stock market offers opportunities for individuals to participate in the ownership of companies and benefit from their growth. While there are risks involved, understanding how stocks work and how to navigate the market can significantly improve your chances of success. Before we get started, subscribe to our channel and turn on the notification bell so you never miss our latest content. Understanding the stock market. The stock market is a place where individuals buy and sell ownership shares of companies. When you purchase stock, you become a partial owner of the company, which can give you the potential to benefit from its growth through dividends and capital appreciation. The two main stock exchanges in the U.S. are the New York Stock Exchange and the NASDAQ, where stocks are listed and traded. Understanding the mechanics of the stock market is critical for anyone looking to invest. There are also other exchanges and over-the-counter markets offering different opportunities for investors. The stock market provides an avenue for investors to buy partial ownership in publicly traded companies. By participating in the market, you gain access to potential profits through dividends and share price appreciation. This dynamic environment is essential for anyone looking to grow their wealth over time. However, it's important to grasp the fundamentals before diving in. Types of stocks: common versus preferred. When investing in stocks, you'll encounter different types of stocks, with common and preferred being the most prevalent. Common stocks are the most widely traded and offer voting rights, meaning investors have a say in the company's operations and decisions. Preferred stocks, on the other hand, do not typically come with voting rights, but offer priority in receiving dividends and claims on assets in the event of liquidation. Each type has its benefits and drawbacks, and understanding the differences can help you make informed decisions based on your investment goals. Common stocks are the most familiar to investors, with shares that trade on major exchanges. These stocks provide a stake in the company's future growth and profits. On the other hand, preferred stocks are less volatile and are often favored by income investors because of their regular dividend payouts. Preferred stockholders have priority in the event of company liquidation, making them a safer bet in certain circumstances. Setting investment goals. Before diving into stock investing, it's crucial to set clear and achievable investment goals. Whether you're aiming for long-term growth, saving for retirement, or seeking a steady income stream, your goals will help define your investment strategy. Your risk tolerance, timeline, and financial situation should all be considered when setting these goals. This foundation allows you to make informed decisions and adjust your approach over time as market conditions evolve. Your goals will directly influence your investment choices. For instance, if you're investing for long-term growth, you may be willing to take on higher levels of risk with growth stocks. On the other hand, if you're looking for stability and regular income, dividend-paying stocks or bonds might be more suitable. It's important to evaluate your risk appetite and time horizon to determine an appropriate investment strategy. Risk and reward. Balance in your portfolio. All investments come with a level of risk, and stocks are no exception. The value of a stock can fluctuate due to a variety of factors, including company performance, industry trends, and broader economic conditions. As a beginner, it's important to understand that risk and reward are inherently linked. A well-balanced portfolio, which diversifies across sectors and asset classes, can help mitigate risks while positioning you to take advantage of growth opportunities. Diversification is the strategy of spreading investments across various assets to reduce the risk of any single asset, dramatically affecting your portfolio. By owning a mix of stocks from different sectors, technology, healthcare, finance, you can potentially reduce the impact of a downturn in any one sector. This approach ensures that your portfolio is less vulnerable to significant market fluctuations. Stock valuation. How to choose stocks. Valuing stocks accurately is crucial for identifying good investment opportunities. There are several methods used to evaluate stocks, including price-to-earnings ratio, price-to-book ratio, and discounted cash flow analysis. These metrics help investors assess whether a stock is undervalued, overvalued, or fairly priced. Understanding how to evaluate a stock's intrinsic value allows you to make informed decisions that align with your investment goals. Stock valuation is the process of determining a stock's fair market value based on its earnings, assets, and other financial metrics. By using various valuation techniques, you can assess whether a stock is priced appropriately or if it represents an investment opportunity. Learning how to evaluate stocks will help you make informed decisions and avoid costly mistakes. Long-term versus short-term investing. When it comes to investing in stocks, there are two main approaches: long-term and short-term investing. Long-term investing involves holding stocks for many years, allowing them to grow in value over time. Short-term investing, on the other hand, typically focuses on quick gains through frequent buying and selling of stocks. Each approach has its pros and cons, and the right strategy depends on your financial goals, risk tolerance, and investment horizon. Long-term investing is generally recommended for beginners because it allows investors to ride out the market's ups and downs, with the potential for significant growth. Short-term investing, such as day trading or swing trading, can be exciting but requires a lot of time, knowledge, and experience. It is riskier and more suitable for those who are comfortable with frequent market fluctuations and who have a deep understanding of stock movements. Monitoring your investments. Once you've made your investments, it's important to regularly monitor the performance of your stocks and overall portfolio. This doesn't mean checking your stock prices every day, but reviewing them periodically to ensure that your portfolio aligns with your goals. It's also important to stay informed about market trends and any significant news that may affect the companies you invested in. Regular monitoring allows you to make adjustments as necessary, helping you stay on track to meet your financial objectives. A well-thought-out investment plan requires ongoing attention. While it's important to avoid making knee-jerk reactions to short-term market movements, staying informed and making adjustments based on your goals and the market environment is key. If you enjoyed this video, give it a thumbs up and subscribe for more content. Hit the notification bell to stay updated with our latest videos. Share your thoughts in the comments below. Thank you for watching.